If you log online right now, you'll see thousands of ads promising AI trading signals that guarantee massive returns. You buy the app, type in a prompt, asking what stock will pump this weekend, pull the lever, and wait. But then you watch your account bleed to zero. The problem lies in how we perceive the technology. Large language models do not possess foresight. They are pattern recognition engines trained on unstructured text. They are built to predict the next word in a sentence, not the next move in the S&P 500. This diagram illustrates the discrepancy. On the left, the retail trader uses a lazy prompt. Asking an AI what to buy is just outsourcing your thinking. The AI hallucinates a confident answer based on historical web text, and you end up gambling. On the right, the institutional trader does the exact opposite. Notice how the professional never asks the AI to make a choice. Instead, they provide the AI with strict rules, historical context, and structure. They use it as an operator for instantaneous data synthesis, processing raw information so the human can make a calculated decision. Think of AI as a high-performance jet engine. If you strap it to a foundation of poor risk management and emotional habits, you aren't creating an edge. You are just accelerating your inevitable crash into a wall. Let's look at the morning routine. The average amateur wakes up and immediately starts scrolling through dozens of conflicting opinions on social media. They get overwhelmed, feel the fear of missing out, and place an impulsive trade 5 minutes after the opening bell. A professional's pre-market routine is designed to achieve one specific goal: contextual clarity. Instead of reading 20 macro articles, they feed overnight news, bond yield movements, and central bank speeches directly into an AI framework to extract a structured summary. They don't just ask when the news is happening. They prompt the AI for historical context, asking how the market has reacted during the first 30 minutes following an inflation report beat under a hawkish or aggressive interest rate environment. This data synthesis produces a customized daily execution checklist. If high-impact news is scheduled for 10 a.m., the AI explicitly flags a rule to have a flat or reduced position size by 9:55 a.m. Up to this point, the AI hasn't made a single prediction about where the market is going. It has simply stripped away the noise and enforced strict trading boundaries before human emotion even enters the room. Once the market opens, a trader turns to the charts. This is where confirmation bias kicks in. You stare at a screen for an hour, form a bullish opinion, and your brain actively searches for reasons to justify a trade you already want to take. Looking at this 4-hour chart, it seems like a perfect setup to buy. But professionals counter their own bias by uploading a screenshot of this raw chart directly into a multimodal AI model and asking it to play devil's advocate. The AI audits the chart and returns a structural scenario matrix. Instead of a directional prediction, it points out that price is trading directly into a major weekly supply zone, and that taking a long position right here carries heavy risk. It maps out the exact parameters of the setup, dropping rigid green and red invalidation zones on the chart. It highlights the precise liquidity pools where the original thesis falls apart, detailing multiple ways the trade can fail. This 10-second audit creates a mental shift. You are no longer acting as a prophet trying to guess the next move. You are operating as a defensive risk manager, prepared for multiple structural possibilities. After the market closes, there is one task nearly every amateur avoids: journaling. Manually analyzing hundreds of past trades to spot subtle behavioral flaws takes immense effort, so most people just write down their profit or loss and walk away. But your historical data contains the map to your personal profitability. Watch this dashboard as a raw, messy CSV trading log transforms into visual charts. The AI instantly acts as an elite quantitative analyst sitting right beside you. The AI performs a deep dive correlation analysis in seconds. It might reveal that your win rate is a solid 68% in the morning, but collapses to 31% after 1 p.m., wiping out your profits due to afternoon fatigue. It can even quantify emotional leaks. The data might show that when you take a trade within 10 minutes of a previous loss, your average risk increases by 45%. That is undeniable statistical proof of revenge trading. The AI holds up a mirror to your trading psychology. The data isolates the exact point where a profitable system yields to a specific behavioral leak, turning an abstract frustration into a fixable metric. But there is a massive risk to integrating these tools. If you blindly trust AI without human oversight, it will silently destroy your account. Large language models hallucinate live math calculations, and if you use them to build complex systems with dozens of indicators, you end up overfitting your strategy. It will look perfect on historical data and then immediately fail in live market conditions. Furthermore, AI lacks execution context. It does not feel the reality of a live market. It doesn't factor in spread expansion, order slippage, or liquidity gaps that occur during major market events. AI proposes, but the human disposes. Once the session begins, the model is turned off. You, as the risk manager, retain 100% of the execution authority. AI does nothing to cure greed or replace the internal work of building psychological resilience. However, for a trader with an established process, it provides the efficiency and clarity needed to execute that edge consistently.